Welcome. I'm here today with Ian McLennan, a partner at TriplePoint. Welcome, Ian.
Hi, Rob.
So, Ian, you're here to give us some information about TriplePoint. So would you like to give us a background on you and TriplePoint? How did it start and when? And where are you guys now?
Yeah, sure. So TriplePoint started 2004. It actually started to run a venture capital trust, which I think we're going to talk a bit about later on. Since then, it's branched out. The company now manages £3 billion across various different strategies. We've invested over 600 million now into SMEs and startups, both debt and equity capital. But I'm here to talk today about my team, which is the venture capital team. 6 of us focusing on equity investment into startups and early stage businesses. I've been with TriplePoint for 14 years now, always involved in private investment, and before that, a career in institutional investment management and research.
Nice. And so I think the first thing that our investors will want to hear about is your investment thesis. So what is your focus in terms of business model, stage, and sector, and why?
Yeah, well, I'll start with sector. We are laser focused on business-to-business technology companies, mainly software companies, which are businesses which have got software selling to other companies, helping them to automate, helping them to become more efficient, make the best use of the new technology that's available, the cloud, etc. So that's our focus. And one of the reasons that we focus on B2B technology is that we can speak to the customers, even if they've only got 1 or 2 customers, very early stage. We can go and speak to their corporate customers and say, look, how important is this to you? Is this business critical, or is this just a nice to have? Because there's a lot of software packages out there being thrown at these companies, and they're only going to pick the ones that really make a difference. And with B2B, we can go and do that. It's much harder with consumer end customers. Of course, you'd have to do some sort of massive survey of all of the potential customers. And another reason that we like B2B software in particular is we think it's much more scalable with the sort of funds that are available to startups than consumer businesses, where you need a big marketing budget right away, really, to test the market. So that's the sector. In terms of focus, in terms of stage, we are looking at seed stage investing. So that's typically a company that's got revenues already of a few £100,000 on an annualized basis, might be raising £1 to £3 million. We would invest somewhere between £500,000 to £1.5 million from TriplePoint. That's about it.
Really interesting, Ian. Can we dig down a bit more into the B2B focus and what makes it so different from B2C?
Yeah, so with B2C, you're always obviously constantly looking for where your next customer's coming from, next customer transaction. Whereas with the B2B companies, they usually will have, if not annual, then multi-year contracts with their customers. So they're at least 1-year contracts, often 5-year contracts, known as software as a service, where these corporates are buying up to these software packages for the long term. So that means we've got much more visibility on the revenue of the companies that we're investing in, and we can see that building over time. A second issue would be that we've looked into which companies are more likely to be sold in the UK. And obviously when we invest, we are investing looking for an exit. We want to make good money for our investors, typically looking to make 10 to 20 times return when we first invest. For that, we need to know that there's going to be an exit for the business. And we've found that there are twice as many exits in the UK of B2B companies as there are to consumer companies. And I think that's because there are just a lot more bolt-on acquisitions by bigger software companies in the B2B space. And also we find that private equity companies, which are potential buyers of these businesses we're investing in, are more interested in B2B as well.
Really interesting. And we'll come back to those exits in a bit, because I think you guys have got some really interesting stories there. So within your stage and sector, how do you view yourselves as different to other VCs that you compete with?
Yeah, well, I think we're still a relatively young fund. Fund's been around about 3.5 years, not such a long time relative to some of the bigger funds in our industry. I think we're still more nimble. because we're a younger fund, we're a smaller fund, we can react more quickly to opportunities. We were talking about one actually earlier today, which has only come across our desk at the start of this week, and we need to do our due diligence very quickly and decide whether we want to invest this week. And we were able to do that. We're not kind of stacked with a huge amount of different processes, etc. And because we invest at seed stage, I think there's the potential for us to make higher returns than some of the other funds, which are managing more money. They need to invest bigger checks. They're investing at a later stage. We think we can already capture some of the early value creation by being a little bit earlier stage than the others.
And so besides funding, what does TriplePoint do to help companies succeed?
Yeah, so one thing we do, there's a couple of things there. One is actually for these B2B software companies, they themselves spend a lot of money and time on software as well. Obviously, these are run by founders who are very tech focused, very tech savvy. They want to use the latest technology, the latest software. So you'll typically find that our companies already are using 30 or 50 other software packages in their own tech stack. So what we've done at TriplePoint is we've partnered up with over 100 providers of services to SMEs, including a lot of software companies, from Amazon to HubSpot to Stripe or whatever, and some smaller ones as well, to organize discounts and easier access for our companies. So that sort of lets them get on with that more quickly, and our investees our portfolio companies can focus on doing the sales and looking after their staff or whatever. We also have an advisory committee. So we've got a panel of external advisors who are entrepreneurs themselves, of successfully exited businesses. So they've been through the founder journey themselves to exit, and they are still interested in giving back to the startup community. They're still very interested in small businesses and helping other small businesses. So, if necessary, we can introduce those guys to our companies and give them some extra advice. And I would say, the other thing is just, over time, we're investing at seed stage. So we actually get to know these companies over quite a long time rather than coming along later. So we've often got quite a strong bond with the founding team, and they'll come and, just direct to me and my team and speak to us for informal or formal advice.
I'd imagine that package is compelling to entrepreneurs who are going about their startup journey. And so pivoting over to discussing about what it looks like for investors, how diversified do you expect that the investors' TriplePoint portfolio would be?
They will be buying into an existing portfolio which already has 37 companies in it. So it's already very well diversified across a range. I've mentioned B2B obviously already, but across a range of different sectors within B2B technology, from fintech to digital health, to back office automation, cybersecurity, etc. And each year we will invest in about 12 new companies. I think we're going to talk about VCTs later on, but one of the benefits is when you invest now, you are investing into that existing portfolio of 37, as well as getting exposure to the next 12, 24, 36 that we're going to invest in. So it is a broadly diversified portfolio in terms of number and sectors.
Deal sourcing is the absolute lifeblood of venture capital. How do you source your deals, and what is your edge?
Well, we use what we call the TriplePoint Venture Network, which is a whole range of contacts that TriplePoint have built up over the last 18 years, from corporates, sometimes getting deals introduced by companies that are already using the software of the companies we're going to invest in, from other investors. If it's an earlier stage business, we might meet a business through angel investors who've already invested in the business or want to co-invest with us. We might meet through other venture capitalists. Increasingly also what we're doing, Rob, is outbound origination, which means that instead of waiting for deals to come to us or for our contacts that I've just talked about to bring deals to us, we will actually say, which sector do we think is interesting? And, is it cybersecurity? Is it big data? and which companies raised money a year or so ago and might be wanting to raise money again. And we will go out and directly contact those companies that way. And also, we are practicing what we preach in terms of software. So we're starting to use software as well to help us sift through the data in terms of what's going on in the startup world and where should we be targeting that outbound reach to find new businesses. So between all of that, I can assure you that the issue is not finding investment opportunities. It's trying to pick the ones that we think will make the money for the investors.
I imagine it's a challenge, but quite a nice challenge to have. Yeah. So you're investing at a very early stage. I imagine that it's going to be heavily about the team behind the business as much as the business idea itself. And so how do you build your conviction in the team that you're looking to invest into? What characteristics do you look for?
Yeah, it's very much about the team. It's also about the product and the market. And so just to touch on all of those, it might be a team or it might be a single founder, but with the key founder, we are obviously looking for drive and passion. That goes without saying, but also domain expertise. Do they really know about this problem that their software they're telling us is going to solve? And also, I think we're looking for a bit of a sort of personal connection there as well. Do we get on with this founder? Do we believe in them? And then the product, this is kind of gets back to the B2B software focus. So the product, is it really fulfilling a key problem for their customers, for their business customers? Or is it just a nice to have, the sort of question that I was raising earlier on? And that's where, speaking to the customer is going to be important. Getting references, making sure that it is a product that brings a return or a big cost saving for the customer. And then the other key issue is what's the size of the market for this product? Because, as I said earlier, we want to be investing in companies where we are making at least 10 times our money if things go reasonably well. And for that to happen, we need to know that there's a big potential market out there. So not just a market size of 10 or 20 million pounds, but hundreds of millions of pounds, preferably billions of pounds, so that this can be a company worth hundreds of millions of pounds in due course.
On to performance. So how has the fund performed in recent years?
Well, the first thing to say, Rob, of course, is still a relatively early fund. And as you know, in venture capital, the returns to venture capital investing come over a 5 to 10 year period. But having said that, to answer your question, since March 2020, the total return on the fund has been 28%. I should also add that around 1/3 of that total return has come via cash returns to investors via dividends.
One of the other benefits, along with the performance of venture capital, is the proximity to innovation, proximity to interesting startups. And so what investments that you have are you most excited about?
Yeah, well, there are quite a few to pick from, but I'll focus on three. One area where we're still seeing a lot of exciting opportunities is digital health. So a year ago, we invested in a company called Knock Healthcare, who provide a telemedicine platform. One of the things it does is allow for remote consultations. They've got global reach. So one of the things they're doing is they're making remote consultations possible outside of urban areas, thinking about developing countries as well in rural areas. They've got a lot of interest in their software from hospitals, but also from health insurers. And they're going great guns. Their revenue's risen about 3 times since we invested in them. Another would be in the area of cybersecurity. A company that we've invested in more recently in the last few months is Outthink, and they're addressing cybersecurity more at the human level rather than necessarily the technical area. So actually identifying where are the potential human risk elements within the corporate. And I don't know if you know, but still 80% of security breaches come from human error, like responding to phishing emails or whatever. And they're introducing AI and machine learning to try and exactly identify where might the potential risks be in the organization. So it's a new investment. We're very excited about it. And then I just wanted to touch on an older investment that we've had for a few years, Ably. It's involved in real-time data. So it's helping with the software and the pipes to make sure that people can get the data when they need it. People have become increasingly impatient about, how fast their computer connection is, their download times, etc. But this is for more specialist niches. So think about urban transport companies. They need safety data instantly, and they'll pay to get that faster. Think about financial markets as well, where you need data very rapidly. And Ably's already been through we invested in Series A stage, and they've already been to their Series B stage, and they're continuing to grow strongly at the moment.
Some compelling companies there. That's really interesting. So there are a couple of other companies that we can talk about as well. You mentioned earlier the link between B2B and exits, and you've already had some exits, haven't you? Which is compelling for such a young fund.
Yeah, we've had 2 exits, Rob. This year, really happy that one of our portfolio companies, Credit Kudos, was sold, and the media have picked up on this quite a lot, to Apple. And that made the fund a 5 times return over the 2-year investment period. So we were pleased with that. Credit Kudos was using open banking in order to produce what we call new age credit referencing software. So actually using the information from people's bank accounts in order to decide what their credit rating is. And before that, we had a company called Adepto, which actually was one of the ones that was introduced to us by a corporate that was using the software when we first invested. And they sold to a bigger player, a bigger HR tech player called Degreed in San Francisco. So we were quite pleased with that as well.
We're sat here at the tail end of 2022, and we've seen some significant valuation adjustments in public markets and also in late stage venture capital. How do you see this environment impacting your fund performance?
Yeah, I think this is an important point. The first thing to say is, of course, we're, as I've mentioned, focused on seed stage, earlier stage investing. And there's some stats out earlier this week, actually, showing that for that stage of investing, the amount of capital going into startups is holding up quite strongly in 2022 to date when we're speaking. So there's been less effect there than maybe on the later stage. So the listed sector, the giant companies, but also the listed unicorns, they have more effect on the kind of Series B, Series C stage valuations. We do, because we've had a couple of companies like Ably that grew very quickly. We do have a couple that were slightly later stage. And of course, we have constantly been thinking about whether the valuations were right since we started to see the tech sector correction, and where necessary, making provisions against that.
And of course, you're investing over such a long time horizon that naturally it's less correlated to public markets, at least what's happening today. So we have a lot of investors who are new to venture capital. So why would you invest in venture capital either over or alongside other potential investments such as the stock market or art or anything else?
Yeah, I think venture capital is an important part of a diversified investment portfolio alongside those other asset classes. And what venture capital brings for you is first of all, just being involved in terms of the amount of innovation that's going on today. But also, I think it brings you a higher return potential than some of the other asset classes. And as you've just mentioned yourself, actually, Rob, generally there's a lower correlation between venture capital and some of the other asset classes as well. So if you've got a time where you feel like you're overexposed to equities or whatever, then venture capital can bring you a bit of diversification from that.
You mentioned the potential growth of early stage investing. There are other options for people out there, and some that people may have tried beforehand. So how would you compare venture capital investing to the likes of crowdfunding and angel investing?
Well, we've already mentioned diversification in terms of the number of companies in the fund. I think some of the other elements are, we're the ones who can spend the whole of the week looking at these, and longer in some cases, looking at these companies. So for an angel investor, it takes a lot of time to filter through what might be the best ideas, whereas we're seeing 1,000 ideas a year. There's the time element. Then because we're seeing so many different ideas and reviewing them constantly, I think we have a pretty good notion of which ones are the best, and we can compare them and selecting them and building them into a portfolio.
And so to round off, why VCT and why TriplePoint in particular?
Okay, so I think for VCTs in general, the benefit is diversification. You're getting instant access to a ready-built portfolio that will then add more portfolio companies as the year goes by. And secondly is the tax benefits, up to 30% tax relief for income taxpayers. In terms of TriplePoint, the two things I'd pick out are our laser-like focus on B2B software companies in the portfolio, which we do partly because we think that's the best way to get great exit potential, get great growth potential. And secondly, our focus on seed stage investing, which is a bit different from some others, which again we do because we think that gives us better growth potential.
Thanks very much, Ian. If you'd like to learn more about TriplePoint, you can view the full investment opportunity on this page. If you need to get in touch with us, you can use the live chat or get in touch by email.